Hello, everyone, and welcome to today's presentation. I'm glad you could join us. Today, we'll be exploring some common misconceptions about mutual funds. The title of our talk is Some Common Misconceptions About Mutual Funds. Throughout this session, we'll clarify what mutual funds really are, debunk myths, and help you make better investment decisions. So, without further ado, let's get started and discover the truth behind these misconceptions. Let's talk about how mutual funds work. Usually, they need a large amount of money to start investing, which might seem intimidating at first. But here's the good news: you don't need millions to get started. In fact, you can begin investing through a systematic investment plan, or SIP, with just $500 a month. Yes, just 500. And you can continue this as long as you want. This makes investing much more accessible and flexible, especially if you're just starting out or want to gradually build your wealth. So, even with a small amount each month, you can participate in the growth of mutual funds and work towards your financial goals over time. Mutual funds are often misunderstood as being only for experts, but that's actually a misconception. The fact is, mutual funds are designed for everyday investors who might not have the time, knowledge, or skills to pick individual securities on their own. That's where professional management comes in. Fund managers are experts. They conduct extensive market research and analyze a wide range of data before making investment decisions. Their goal is to maximize returns and manage risks on behalf of the investors. So, while it might seem complex, the key takeaway is that mutual funds are actually created for common investors, providing them access to professional expertise that they might not be able to achieve on their own. This ties into our overall theme of making investing accessible and manageable for everyone. Mutual funds are generally considered profitable when held over the long term. That's because markets tend to grow over time, and staying invested allows you to ride out short-term fluctuations. But it's important to remember that there are also various short-term schemes available. These can be suitable if you're looking to invest for a shorter duration or have specific financial goals within a certain time frame. The key here is to understand your own risk profile and investment horizon. That's why I always recommend consulting a financial advisor. They can help you choose the right funds or schemes that align with your risk appetite and financial objectives. So, whether you're planning for the long haul or looking for short-term options, the right guidance can make a big difference in how your investments perform. This way, you can make smarter decisions and optimize your investment strategy as part of your overall financial plan. Let's talk about a common misconception: never invest in a down market. Many people think it's better to wait until markets recover, but that's not always the best approach. The fact is, market ups and downs are completely normal. What's important is to stay consistent with your SIP, even when the market is down. In fact, investing during a downturn can work to your advantage. When the market dips, your fixed SIP amount buys more units than it would in a rising market. Over the long run, this can significantly benefit your investments as the market recovers and grows. So the key takeaway here is, don't panic when the market falls. Instead, continue your SIPs. This disciplined approach helps you accumulate more units at lower prices, which can lead to better returns over time. Staying steady through market fluctuations is a crucial part of building wealth in the long run. Let's clear up a common misconception about mutual funds. Many people believe that all mutual funds are directly linked to the stock market, but that's not entirely true. In fact, not all mutual funds invest in stocks. You can also find mutual funds that focus on government securities, bonds, or treasury bills. These are all different types of investments that tend to be more stable and less risky compared to stocks. So, when you're considering mutual funds, it's important to understand that they are not limited to just equities. They can be tailored to fit different investment goals, whether you're looking for growth or safety. This connects to our overall theme of understanding the variety of investment options available, helping you make more informed decisions. Let's clarify a common misconception about mutual funds. Many people believe that all mutual funds have a lock-in period. However, that's not entirely true, especially when it comes to open-ended mutual funds. The fact is, You can actually buy and sell these funds on any business day. This flexibility is one of the key advantages of open-ended mutual funds. It means you're not restricted to specific dates or lock-in periods, giving you the freedom to manage your investments more actively. This aligns with the overall theme of understanding how mutual funds work and the benefits they offer. So remember, open-ended mutual funds are quite accessible and flexible in terms of transactions. You might think it's too early or too late to start a systematic investment plan, but that's actually a common misconception. The fact is, starting early is one of the biggest advantages you can have. The earlier you begin, the more you can benefit from the power of compounding, which really works in your favor over time. Now, I want to emphasize that there are several funds available tailored to different ages and financial needs. So, whether you're just starting out or thinking about investing later in life, it's never truly too late to begin. The key takeaway here is that no matter where you are in your financial journey, taking action now can set you up for better returns in the future. Remember, the goal is to make informed choices that align with your personal circumstances, and there's always a suitable option available to help you achieve your financial goals.